Somewhere in your house there is a piece of paper with a date on it. A date so far away that you can't really picture it. 2051, 2055, 2058. That's the day you finish paying for the room you're standing in. 30 years, that's the deal. You sign a stack of documents you don't fully read, a bank hands over a sum of money you will never hold, and in exchange, you promise the next 3 decades of your working life. And here's the strange part. Nobody argues about it. We treat that number the way we treat the tides, like it was always there, like somebody discovered it rather than invented it. It wasn't always there, not even close. For the first 150 years of this country, there was no 30-year mortgage. There was no fixed rate you could count on. And there was no such thing as a loan that got smaller every time you paid it. Every one of those ideas had to be built from nothing, by people watching the American housing market burn to the ground. So here's the question that starts everything. If none of that existed, how did anybody buy a house? And what went so catastrophically wrong that the federal government decided it had to redesign, from scratch, the way an entire nation pays for shelter? We're going to meet a working man in Pennsylvania who, in 1831, became the first person in America to borrow his way into a home through a system his own neighbors invented. We're going to open a mail order catalog and buy an entire house out of it. 30,000 pieces shipped to your nearest railroad station, instructions included. We're going to stand in an Iowa farmyard where neighbors bought a foreclosed farm for 1 cent and handed it straight back to the family that lost it, and we're going to watch a judge get dragged out of his own courtroom by farmers with a rope. Because this isn't really a story about interest rates. It's about who gets to own something in America and who gets told to keep renting. And it's about a promise that was handed to millions of families and deliberately withheld from millions of others. Let's open the vault. In the first decades of the Republic, no bank was going to lend you money for a house. Most of them weren't even permitted to. Back then, ownership in America meant land, and land meant the federal government. After the Revolution, the new United States found itself sitting on an amount of territory nobody could picture. Millions of acres stretching west, most of it never seen by the men arguing over it in Philadelphia. How to hand it out became one of the loudest political fights of the era. The first serious attempt at a system was the Land Ordinance of 1785. It sliced the public domain into tidy townships 6 miles square, then into sections of 640 acres apiece. Straight lines, clean records, no arguing about which oak tree marks the corner of your farm. One problem: you had to buy an entire section, 640 acres, paid in full. For a farm laborer earning a few dollars a week, that wasn't expensive. It was fictional. Congress softened it by 1800, and it was still out of reach for exactly the people willing to load a wagon and go. It worked beautifully for the men it was quietly built for. Speculators, who bought enormous parcels and resold them in slices at whatever the market would bear, which left everyone else one option: go anyway. For decades, the most common way an ordinary American came to own land had nothing to do with paperwork. You walked onto ground nobody had surveyed, cut trees, built a cabin out of what you cut, put in a crop, and hoped that when the government finally drew its lines, somebody would notice you'd been there 6 years. It was called squatting, and it is the foundation of a shocking amount of American property. Then, in the middle of a civil war, the rules changed. In 1862, with the Southern legislators who had blocked the idea now absent from Congress, Abraham Lincoln signed the Homestead Act. The offer was almost absurdly simple. Any adult citizen could claim up to 160 acres of public land. Live on it, farm it, stay 5 years. Then it was yours, for a filing fee of about $10. Before the program ended, it moved more than 270 million acres into private hands, 10% of the entire land area of the United States. That is how the middle of this country came to be owned. Not through banks, through 5 winters and a plow. Here's the catch. Every acre of it was farmland. None of it did a thing for the man working 12 hours in a Cleveland foundry. The cities were filling faster than anyone could build for, and not one of those arrivals needed 160 acres of prairie. They needed a narrow lot on a crowded street. For them, the question was completely different. If you wanted to buy a house in an American city around 1900, there were exactly 2 doors, and neither was built for you. Door 1, pay cash. The whole price, on the day of sale, out of your own pocket. The number of families who could do that was close to 0. Door 2 was called a mortgage, But that word is doing a lot of work because it bore almost no resemblance to the thing you'd sign today. Start with the down payment. A lender in that era typically wanted half, sometimes more. Say a solid working-class house ran $4,000, a fair figure at the turn of the century. That meant showing up with $2,000 in cash before anyone would talk to you. Now put that next to a paycheck. The average American worker in 1900 earned somewhere between $400 and $500 a year. Not a month, a year. So do the math with me. $2,000 is 4 full years of wages. Every dollar of it. 4 years with no rent, no food, no coal, no shoes, no doctor. Nobody did that. The arithmetic simply doesn't close. And if you somehow cleared that wall, what waited behind it was worse. A home loan in the late 1800s came from a savings and loan, a local bank, sometimes a life insurance company. The term was short, 3 to 5 years, rarely more. And during those years, you did not pay down the debt. Not a dollar. You made interest payments, month after month, renting the use of the bank's money while the amount you owed sat there completely untouched. Then, at the end of the term, the entire original sum came due, all at once, in cash. They called it a balloon payment, which is a strangely cheerful name for what it actually was. Picture it from inside the house. 5 years of payments made on time. 5 Christmases in that front room. Your kids know which stair creaks. And then a letter arrives explaining that the full amount of the loan, the same number you borrowed on day 1, is payable this month, and the bank would like it now, please. Some people survived that moment. Refinancing was the usual escape hatch, and in good years it swung open easily, but refinancing is only a door when somebody is willing to open it. In a bad year, a bank in trouble, the local factory shut, credit tightening across the county, that same lender said no, and there was no second option. You didn't have the lump sum. Nobody had the lump sum. That was the entire point of borrowing in the first place, so you lost the house. Not because you missed a payment. You never missed a payment. You lost it because the clock ran out, and plenty of families were on a thinner wire still. If you couldn't reach the down payment, a broker could stack a second mortgage on the first at a rate that would make your eyes water, and sometimes a third on top of that. 3 lenders, 3 schedules, 3 separate clocks. That was the American housing market, not a ladder. A game of musical chairs where the music was the credit cycle, and nobody controlled when it stopped. Now, into that mess walks an idea so simple, it's almost embarrassing nobody had tried it sooner. In January of 1831, in Frankfort, a mill town just outside Philadelphia, a group of working men sat down in a tavern and formed the Oxford Provident Building Association. Each member bought shares and paid into the pot every month. Once the pot held enough to buy or build a house, one member took the money and became the borrower, still paying in, now as a debtor instead of a saver, while the pot filled back up from everyone else. Then the next member's turn, and the next. No bank, no outside investor, neighbors, financing each other's houses in sequence. The first man to get the money was a lamplighter and comb maker named Comley Rich. He borrowed $375 and bought a narrow little house on Orchard Street. And here's my favorite part. That house is still standing. A lamplighter's house in Philadelphia, and it has outlived every bank that would have turned Comley Rich away at the door. How did they decide whose turn it was? Many of these associations auctioned it. Members bid against each other for the right to be next, offering a premium off the top of their own loan. If you needed a roof this year instead of in 4, you paid for the privilege. To your neighbors, who were also your lenders, sitting across the table watching you bid. And here's what mattered most. Their loans amortized. Every payment knocked something off the principal. 8 years, 10, sometimes 12, and at the end you owned the house outright with no balloon waiting at the finish line. Next to the bank's 5-year interest-only trap, it wasn't even the same product. They spread like a rumor. By 1930, the building and loans counted 12.3 million members and close to $9 billion in assets. By the Richmond Fed's measure, nearly half of all institutionally held home mortgage debt in the country. If your great-grandparents owned a house in America, there's a good chance one of these neighbor-to-neighbor societies is the reason. But they weren't the only ones who noticed ordinary people couldn't buy houses. Somebody else was watching, and their solution was, frankly, insane. Starting in 1908, you could order a house out of the Sears catalog. Not a plan for a house, the house. You picked your model, and Sears shipped a boxcar holding about 30,000 pieces of it, lumber cut to length and numbered, 750 pounds of nails, 27 gallons of paint, the doors, the window glass, the staircase, the doorknobs, and a 75-page instruction book with your own name stamped in gold on the cover. It arrived at your railroad depot, and it was your problem from there. Sears sold something like 70,000 of them, and from 1911 the company did the thing the banks wouldn't. It financed them itself. House and loan, same catalog. Meanwhile, Washington had discovered it had opinions about home ownership. In 1917, the Department of Labor took over a realtors campaign and ran it nationally under the slogan, "Own Your Own Home." Posters, lectures, pamphlets on how to get a loan, and buttons handed out to school children reading, "We own our own home." And underneath the warm language sat a colder argument. A man with a mortgage doesn't go to radical meetings. In an era of strikes at home and revolution abroad, a homeowner was a citizen with something to lose. Which tells you something. Long before the government was willing to finance a house, it had decided it wanted you in one. And then came the 20s. The decade didn't only roar on Wall Street. Wages were rising, credit was loose, and the country had talked itself into a mood where a downturn seemed like something that happened to other generations. Between 1920 and 1930, total residential mortgage debt in America tripled. Home ownership climbed with it to a peak near 48% by 1930. On the surface, progress. Underneath, the same balloon mortgages as always, only stacked higher, with second and third loans piled on and less of the buyer's own money in the deal than ever. Florida is where the fever showed clearest. In the mid-20s, land there changed hands so fast that a whole trade grew up around never actually buying anything. Young men in cheap linen suits worked the sidewalks of Miami reselling binders, the paper deposit on a lot, and at the peak a single binder could change hands 4 or 5 times inside 1 month. Plenty of those lots were underwater, not financially. Actually underwater, in a mangrove swamp, which the buyer up in Ohio had no way of knowing. Then a hurricane came through Miami in 1926, and the Florida boom stopped like a dropped plate. It should have been a warning. It was read as a local problem. 3 years later, the market crashed, and this time it reached every street in the country. The banks went first. By 1933, more than 9,000 had closed their doors, and when a bank died, it took its lending with it. Employers cut payrolls. Unemployment climbed past 25%. And a family faithfully making interest payments on a balloon mortgage now had a husband with no job and a lender with no money to refinance them. The numbers from those years are hard to read. In 1926, about 68,000 American homes were foreclosed. By 1932, it was 250,000. And by 1933, 1,000 homes a day were going under the hammer, with something close to half of all mortgages in the United States in default. The building and loans got hit too. Members needed their savings, so they withdrew them. The commercial banks that supplied backup funding failed. The neighbor's pot ran dry. Home ownership fell from that 1930 peak down to 43.6% by 1940. And out in the countryside, people stopped waiting for Washington. Farm foreclosures were settled at public auction, on the property, in front of the family losing it. So the neighbors started showing up. Hundreds of them. They'd crowd the yard, make it very clear that outside bidders were unwelcome, and someone would open the bidding at 1 cent. Nobody bid against him. The sheriff, surrounded, recorded the sale. The buyer handed the deed back to the original owner and everyone went home. They called them penny auctions, and they spread across the Midwest. Sometimes it went past theater. On the 27th of April, 1933, 600 farmers marched on the courthouse in Lamars, Iowa, and demanded that District Judge Charles Bradley promise never to sign another foreclosure order. He refused, so they pulled him off his own bench, drove him out into the countryside, put a rope around his neck, and hauled him off the ground until he lost consciousness. Then they dumped him on a dirt road and left him to walk home. The governor declared martial law in the county and sent in 4 companies of the National Guard. That's how close this got. Not a policy debate. A rope in Iowa over a stack of foreclosure papers. Washington understood the message. The first move came from a president generally remembered for doing nothing. In July of 1932, Herbert Hoover signed the Federal Home Loan Bank Act, creating a network of 11 regional banks modeled loosely on the Federal Reserve, but built for the mortgage business, a lender of last resort for the savings and loans. A real structural fix, and far too small for the size of the hole. Then Roosevelt took office, and the pace changed. In April of 1933, he asked Congress for legislation to protect small homeowners from foreclosure. Congress moved in 2 months. On June 13th, it created the Homeowners Loan Corporation. The HOLC didn't lend to families directly. It did something stranger. It bought their broken mortgages off the banks, paying the lenders in government bonds, then rewrote the loans on terms borrowers could survive, 15 years, fully amortizing at 4.5% to 5%, below the market. Every payment now reduced the debt. No balloon at the end. Its lending authority ran exactly 3 years, and in that window, it refinanced more than 1 million mortgages worth over $3 billion, and it proved the thing the industry had called impossible, that a long, fully amortizing loan is safer for the lender because the borrower's stake grows every month instead of hanging in the air until the final day. The courts were working the same emergency from another angle. In January of 1934, in Home Building and Loan Association versus Blaisdell, the Supreme Court upheld a Minnesota law letting judges delay foreclosures, 5-4. It told every state in the country that government could put its hand on a private contract when enough families were drowning. But the HOLC was a rescue crew, not a housing system. The rescue was working. The system still didn't exist. And then, on June 27th of 1934, Congress passed the National Housing Act and created the Federal Housing Administration. This is the moment. This is where the mortgage you know was born. To see why it mattered, understand what lenders were like in 1934, terrified. They had watched half the mortgages in America go bad at once, and the survivors had no appetite to write another. By some estimates, only about 1 American in 10 could get a home loan on the terms then available. The market was frozen solid. The FHA's answer was almost elegant. The federal government would insure the mortgage. If the borrower stopped paying, Washington covered the lender's loss. Take the risk off the bank, and the bank starts lending again. That's the whole trick. But the insurance came with conditions, and the conditions are the real story. To qualify, a mortgage had to be long-term, 15 to 20 years at first, stretching further as the program matured. Fully amortizing, so the debt actually shrank. A down payment of 10 to 20% instead of 50 or 60, and a fixed rate, so a family knew exactly what the payment would be in year 1 and in year 19. That's the modern American mortgage, assembled in one piece of legislation. Before it, a home loan was a short bet you hoped to roll over. After it, buying a house became a long, boring, predictable thing a person with a steady job could plan a life around. One honest correction, though, because the year 1934 gets used loosely. The 30-year term did not appear that summer. Congress didn't authorize 30-year loans for new construction until 1948, or for existing houses until 1954, and through the late 40s the average loan still ran about 21 years. 30 didn't become the standard until the 1960s, but every one of those extensions was built on the frame that went up in 1934. There was still one structural problem, the kind that only shows up once the plan starts working. When a small savings and loan in Ohio writes a 30-year mortgage, that money is gone for 30 years. It can't lend the same dollar to the next family. Multiply that across the country, and lending grinds to a halt again, this time out of success rather than panic. So in 1938, the government created the Federal National Mortgage Association, Fannie Mae, and invented a secondary market for mortgages. Your local lender writes your loan. Fannie Mae buys it. The lender has fresh cash and writes another. Fannie Mae bundles those loans and sells them on to investors, and the money flows back around the loop. The savings of the entire country could now be pointed at housing anywhere, and then the machine got hit with the biggest demand shock in American history. The war ended, and millions of young men came home wanting the most ordinary thing imaginable: a house, a wife, a quiet street. Almost nothing had been built in 5 years. The Servicemen's Readjustment Act of 1944, the GI Bill, offered veterans home loan guarantees with essentially no down payment and low rates. A man who had shipped out to the Pacific with nothing could walk into a bank, backed by the credit of the United States, and buy a house without putting a dollar down. By 1955, over 4 million loans had gone out under the program. Builders saw the wave coming. In 1946, Levitt and Sons bought 4,000 acres of potato fields on Long Island and started making houses the way Detroit made cars. Same floor plan, crews moving down the line, each man doing one task on house after house. A Levitt house sold for just under $8,000, and a veteran could take one with nothing down and payments of $56 a month. That was cheaper than renting an apartment in Queens. The model was copied everywhere. Where there had been farmland, there were now streets of identical houses with driveways and lawns. The American suburb was mass-produced in about 15 years. The home ownership rate tells it better than anything. 43.6% in 1940, 55 by 1950, 61.9 by 1960. A nation of renters became a nation of owners inside 2 decades, and it has never moved that fast again. But there's a part of this you don't get to skip. Remember the HOLC, the agency that saved 1 million mortgages. In the late 1930s, it drew residential security maps for cities across the country, grading neighborhoods from most desirable to most hazardous, and coloring them in. Green at the top, red at the bottom. And the grading wasn't only about the buildings. Neighborhoods with black or immigrant residents were marked red, regardless of the condition of the houses or the incomes inside them. That practice became known as redlining. The FHA used those maps and refused to insure mortgages in red areas. The Veterans Administration followed. Private lenders followed them. The greatest wealth-building program this country ever ran was routed around millions of families on purpose. The numbers are blunt. In 1947, Ebony magazine went through the Veterans Administration loans issued across 13 cities in Mississippi. More than 3,200 of them. 2 went to black veterans. 2, in a state where black men were nearly 4 in 10 of the returning soldiers. Up north, it wasn't much better. Of some 67,000 GY Bill mortgages written in New York and the northern New Jersey suburbs, fewer than 100 went to non-white families. Levitt's own contracts barred resale to black buyers. And when Bill and Daisy Myers moved into Levittown, Pennsylvania in 1957, crowds gathered outside their house for weeks, and the state police had to be posted on the street. So while white families spent 30 years building equity in houses that appreciated, black families were locked into neighborhoods where lenders wouldn't lend, and values stayed down because of that refusal. The wealth gap that follows isn't a mystery, it's a policy with maps. Step back far enough and the 30-year fixed-rate mortgage stops looking like paperwork and starts looking like what it is, one of the most radical economic inventions of the 20th century. It turned a country where owning a home was a mark of wealth into a country where owning a home was the wealth, the main way an ordinary family accumulates anything at all. It built the suburbs, and with them the highways, the schools, the whole shape of American life. It's also, almost uniquely, ours. In Canada, 5 years is the common mortgage term. In Britain, you fix your rate for 2 or 5 and then take whatever comes. Across most of Europe and Asia, shorter terms and adjustable rates are the norm. The 30-year fixed exists here because this country had a specific catastrophe and built a machine so it wouldn't happen twice, and the machine doesn't correct itself. We proved that in 2008, when loans were written for borrowers who plainly couldn't repay them, packaged into securities, and sold around the world, and Fannie Mae itself had to be seized by the government to stop the collapse. Same country, same asset, roughly the same mistake, 75 years later. Here's what I keep coming back to. Every piece of this was a choice. Somebody decided a loan should shrink when you pay it. Somebody decided the term should be long enough for a factory worker to afford the monthly. Somebody decided which neighborhoods got colored red. None of it fell out of the sky, which means the version we're living in is also a choice still being made. So I want to know what you think. If Washington rebuilt the mortgage from scratch today, the way it did in 1934, what would you keep and what would you throw out? Tell me in the comments. I read them, and that piece of paper in your drawer, the one with the far-off date on it. 100 years ago, it would have been 3 pages of interest-only payments with the whole balance due in 5 years. And a man like Comley Rich would have needed his entire street to pool their wages just to get him a roof. The date on your loan isn't a law of nature. It's a repair, made by a country that had just watched 1,000 families a day lose their homes. If you want more of these, the parts of American life that turn out to have a start date, subscribe and open the vault with us. There's another one waiting for you right here.